Yeah, hi guys. Welcome to the 11th episode of FINtastic Talks. Time really flies. I can't even imagine we are in the 11th episode, and it feels so good to a lot of us who are able to get back to office. You're back to your routine. The virus situation in India is under control, thankfully, and people have been through a very, very tough and a torrid time. So my heartfelt sympathies to all those people who had to go through the tough time, and to all of us that look, this is a time we have to learn from it, and maybe there'll be a third wave, and we have to be ready for it, and we have to get vaccinated. This is my message for the last 2-3 times. That's the only thing we can do, in addition to being careful to help in this fight. Other thing is like working hard and working on Indian economy. I think that it's a time for bounce back. And when we bounce back, there is an opportunity for all investors out there that, there is a lot of money to be made. And as people are saying, the next 10 years, Indian economy is going to be performing fantastically. And you can participate in that. Either you can just look at others and just watch from the side, or you can be a part of that market by investing in that market. So I know it's at an all-time high, and a lot of people are scared of investing. But if you have a 10-year horizon, it's never too late. Yes, there will be ups and downs. There will be times there will be negative, but you need to have the right fund. You need to have the right advisor company like Bajaj Capital. I will be more than happy to keep you on this journey and track. And if you have the right mutual fund, the right fund manager, and the right selection, and you have the patience, and you have the ability to withstand the downturns, then India is going to give a fantastic returns in the next 10 years also. Today, without further ado, I'm going to talk about being relevant, which is the philosophy of my guest today. He's a fund manager, FINtastic, with a very, very different fund management style to what we are used to. We are used to buy and hold. He's a quant-based guy where numbers do the talking, and he doesn't shy away from churning your portfolio. So he's very confident on that. And where people talk about beating the market, the benchmark used to be, okay, I beat the Nifty on my relevant index by 2%, 3%. He beat the same by more than double. So he's given a fantastic performance. He's one of the most amazing persons to listen to, and we would love to hear him how he did it. But before we get into that, my point to all those of you who want to create a career in financial services, wealth management, guys, please do your wealth management. Please do your CFP certification. Go to International College of Financial Planning and do it. It's an amazing, because future only belongs to professionals. And for those of you who want to be investors, I get a lot of questions from first-time investors. As always, we have created a program called FINtastic.com. Please check it out. It teaches you how to invest. And if you know how to invest, then you can use your wealth manager or fund manager, and he can't take you for a ride. So yes, like with anything, if you have to learn something, only then you can master it, or you can learn on the journey. But if you're learning on the journey, you'll make a lot of mistakes, and money is not something you want to make a mistake with. So guys, please check out FINtastic.com. Look at it. Now, without further ado, let me call the fund manager, FINtastic, Mr. Sandeep Tandon. Welcome. It's great to have you, Sandeep, with us today.
Hi, Sanjiv.
Yeah. So, Sandeep, it's great to have you. Generally, most of the fund managers, and always been about a very particular way of managing money. You come in with a totally different mindset. When we were having our last talk, and whenever I've interacted with you, and I'm enjoying your amazing book, which I'm reading.
Thanks.
And thank you for that. It's my like a dinner coffee table. I spend morning I spend some time on it, and in the evening I'm spending some time with my cup of coffee, and I remember you. So it's so let me ask you. You have a very different fund management style of not buying and holding, but actively trading. So why don't you tell us a little bit about yourself? What's your background, and what makes you believe in this style, which is very, very different? Are there other people in India also who are following this, or you are very unique in this?
So, in terms of my own background, I have a very I'm a hybrid, So my parents' side, my mother shifted from Rangoon side, father from Lahore side. So, and you are from Delhi, so you understand what energy level and drive the hybrid have as compared to normal guys. Okay, and it's a combination which has worked well. Okay, and I think what is more important is that in last maybe nearly 3 decades, I have been in the market. I entered the market when Harshad phase was going on. So I'm talking about 92 since I've been in this business, okay, or I've been in the market in some manner or other. What I have learned from mistakes. Okay, I think that is a very important thing that you should learn from a mistake. And what is more important that you should not repeat the same mistake. Okay, how you do it. So that's the way the processes come into place. So over period of time, last nearly 27, 28 years now in the market, I have built a lot of tools which really help us in analyzing the market. In today's world, people talk about big data, analytics, or machine learning. All these complex and new terminologies have evolved. But as a student of applied maths and behavior finance, we have been practicing this for a while. So only thing the methodologies remain the same, mindset remain the thing, techniques have changed. You have new tools and ammunition which can really help us in analyzing the data which used to take some time. So world has obviously changed a lot and we are big beneficiary of that. Okay, so our thought process is that when we talk about market, everybody is emotionally attached. Okay, though we all talk about we should not marry with the stock ideas. Okay, but it's a very natural process. If you're owning a stock for a long period of time and you have made good amount of money, biases get built. Over period of time, people are able to get into that stock. Their timing is perfectly. The real challenge comes: can you get exit on time? Okay, or can you look for another better opportunity and then try to participate? Okay, I think this is the one big challenge we have seen in our life. So in last 30 years, if you ask me what I have learned, the most important learning is how to remove your human biases, and that has only come with the analytics tool which we have built over period of time. Now regarding questions related to churning, so I'll give you a small example. We believe that now we live in a very global world and we actually live in a very dynamic world. Okay, where things are changing on continuous basis. In the morning you look at the Nasdaq, in the evening you're looking for other market, you're looking at the currencies market, commodities market, credit market, you can look at multiple. So we all live in the information overload is there. Okay, how well we can capitalize these things is something very important. If we believe that we are living in a dynamic world, and hence our money management style also has to be dynamic. Okay, and we have, if you, Sanjiv, if you have read that book, I have been talking about from 2017 that 2018 till 2023 we will see extraordinary volatility in the global markets. Okay, we call it volatility expansion phase between 2018 till 2023. So if our predictive analytics is endorsing this theory that this is a volatile market, then we should know how to capitalize. Okay, we have seen in the market, where a lot of individual investors or even money managers talks about, let this dust settle down, we'll buy 20% higher, 10% higher, we don't want to participate in this volatile times. Okay, in my whatever last 20 years experience in the badla market or even in the options market, I was very early in trading in the derivative space. We have tried to capitalize. I have learned this art to make volatility as your friend. Volatility is your new asset class. If you can treat it with this mindset rather than saying with a worry, then you will able to capitalize. So we believe that 2018 till 2023, the moves will not be linear. Okay, and hence can we capitalize? We can only capitalize this opportunity if you manage your money in a dynamic manner. So from 2018 till 2023, we believe that buy and hold strategy will not give any returns. Okay, and not only India, we have seen globally this strategy has failed. Okay, and that's the reason we work a lot of things on the market environment. We call about ourselves that we try to analyze more from adaptive asset allocation approach rather than the looking from the tactical or static or the statical things. Okay, a tactful thing. So it is very, very important to understand the environment. So we are very macro perspective house. We try to analyze whether market is in risk on or risk off environment, how the global liquidity is changing, how the risk appetite is changing, how sentiment data is affecting. Anything which affects market, we try to incorporate in our data. And with the help of machine nowadays, it's easy to analyze these data points on quick basis as compared to few years back when we have to really struggle in the Excel sheet and used to take some time, weeks also, to combine when we're talking about multivariate models. It was not easy. In today's world where technology is on the forefront, we are able to capitalize on it. So our strategy has been a macro house and try to capitalize on the environment. It's very important to understand the what type of environment we are working. If you understand, then you can understand which tools or techniques you have to use in this environment. That's the way we defined ourselves.
Very well said, Sandeep. That, again, this is a question a lot of us are asking. Like your own fund, the small cap has given more than 200% return in the last 1 year. Now, point is that those types of returns are not sustainable, or the funds have given 100% plus return or a 70-80% plus return. So and we know that, okay, in the long term average, the return is going to be 12%, 14%, 15%, or whatever is. So at the end of the day, so there has to be a period of down performance. Now, whether that happens in 1 or 2 years or that happens in 10 years, it's very difficult to predict, and it is making it very difficult for an investor to take a decision. Like me personally, as an investor, I feel I should book some profits, but I'm very confused. Should I book the profit? Do I want to be a fool, who booked the profit at the wrong time and then the market goes up by another 20-30% and I'm holding on to my money for so many years? Or do I remain invested when I see a time when the markets are going to go down by 30%? So now you are the closest to this, Sandeep. What should an investor do? So again, if this was your own money, do you think it's time to book some profits, change the type of funds you are in, and what should you do?
No, let me answer this thing in a very different way. Okay, let me explain. See, when we all have been taught when it comes to market, is all about fundamentals. Okay, and if any money manager you talk, he will give you a big lecture on Gyan on the fundamental aspect. Okay, pure fundamental, how look long term. Okay, but I tell you, when we were these techniques are very effective when markets in India or any emerging market were in the infancy stages. Okay. Indian market is no more in the infancy stage. We believe that Indian market is also in a mature phase. Okay. When the mature phase aspect we are talking about, then you have to look at multi-dimensional research. Okay. You can't just look at the valuation as one thing. It's like, we have seen, Abhimanyu entered into the Mahabharata, the Chakravyuh, but he could not have techniques to come out of that. Okay. So similarly, we have created a framework which we call it VLRT framework. I'm linking with your questions with this thing, where we give 1/3 weightage only to valuation analytics. We give 1/3 weightage to the liquidity analytics and 1/3 weightage to risk appetite, which is sentiments. And as a combination, when our VRT framework is giving you a particular indication as a part of a multi-dimensional approach, okay, where we call it fundamental, the Atma, liquidity, the Prana, and sentiment, the Maya. Okay, this is the way we defined our core belief. Once you start incorporating these other two analytics, liquidity analytics and risk appetite analytics, and risk appetite is different from risk, okay, and it's not inverse of risk. Okay, so if you incorporate these other two techniques also, not only it gives you a well diversified portfolios, also bring down your risk. This is what we concept of multi-asset and multi-manager. When we talking about multi-manager, means any fund manager or any scheme has three approaches, three types of managers are managing: liquidity analytics, valuation analytics, and risk appetite analytics. Okay, so by combining these three things, we actually dilute, okay, the issues which you're talking about, whether we should exit or not exit. Since based on these data points, we try to form an opinion on global analytics based on the data, whether we are in risk on. If we are in risk on environment, we will play on the front foot. If we are in risk off environment, we play on the back foot and revamp our portfolio or rebalance our portfolio in such a manner that I will survive this phase. Okay, because we continues to believe that equity as an asset class will deliver phenomenal return from a longer term perspective. But if you can manage these short-term volatility or near-term challenges in your portfolio, then you will come out as a winner. So we don't advise, people, okay, this is the best time to enter in the market, this is the best time to exit the market. We rebalance our portfolio. And this rebalancing portfolio approach leads to relatively higher churning. Okay. which a lot of people we have been groomed, the churning is bad. Okay, no, churning is not bad. Okay, the churning is good as long it is done from the risk management perspective. So we call ourselves that we are money managers. Later on, we are first risk manager. Okay, and we have been taught how to manage the risk properly. If I manage my risk, my returns will be proper, because we believe that returns are byproduct of risk management. Okay, so when we talk about fund management as a business, we try to optimize on money management, risk management, as well as fund management. All other two techniques are equally important, and when you combine it, let's talk about, I will take few more minutes on this. Let's look at what happened in March 2020. Okay, right from February onwards, this COVID fear was started pouring in, and nobody knows what exactly how big this crisis. In February, it was premature to really talk about how it will unfold. As this crisis becomes slightly deep, we saw market correcting, and in fact, 23rd February there was a reverse circuit also. Okay, and 23rd March of 2020 and 24th March, Nifty made a lifetime or new bottom at that stage, and since we have recovered. Okay, let's understand from the data perspective. So by the end of March or beginning first week of April, what we spotted that our risk appetite for India was at lifetime low, and liquidity was at lifetime high. Okay, this I always explains a very lethal combination for a bull run. Okay, where risk appetite is rising, liquidity is lifetime high. So this is a perfect combination to go all out in the market, and that's a time fear was very high. Our quant fear index was at lifetime high. Okay, the capitulation was one of the best capitulation we have seen. It was the one of the worst as compared to 2008. So the capital index was, even the indicator was much higher than, it was 3 times higher than 2008 crisis, the Lehman October 2008 crisis. So multiple parameters which we track from our predictive models point of view were all endorsing one side. And that's the reason we have incorporated an element of time in our framework called VLRT. T is timing. Most of the people don't want to accept that timing. In fact, we have seen newsletters, campaign, we don't time the market. We are very vocal that we time the market. Okay, it is very important to understand this chemistry. Okay, and I'm using the word it's a chemistry because it's a combination of three parameters which we look at. We are not traders. We are not putting trading on stop loss basis. Okay, or if it works, it works, and otherwise I will put a stop loss and move on in life. Okay, no. When our valuation analytics, liquidity analytics, and risk appetites are on skewed on one side, it helps me in taking a call aggressively long or aggressive pruning down the exposure. So it's a important aspect. Every business house, every investor, every money managers, timing is there in the deep subconscious mind. Okay, the challenge is some people wants to accept it, some people don't want to accept it. We are vocal about it. We accept it. It's a human tendency, and it really helps. And we are doing in a systematic manner. It's not we are punting and or playing in the markets and then say this is a. So timing is also been misused like a trading. People who can't manage money or returns from near-term perspective talk about we are not traders. Okay, so we balance our portfolio. We have put allocation for near-term, medium-term, longer-term, and even we have special situation in our portfolio. So ability is all about how well you balance your portfolio from all three tenure perspective. And end of the day, churning or no churning doesn't matter. What matter is the risk data. Okay, if you analyze the risk data, let me give you small examples. Since you talked about small cap, okay, what we did right was that right from April second week, we not only went deployed our cash, we started increasing our small and mid caps exposure in all the schemes. Okay, depending on the risk profiling and the which category it falls in. That reason, our small and mid cap exposure is relatively high in our portfolio. That has led to a massive outperformance. Okay, and it's not just a coincidence. We follow process, so it's not like that one of our scheme performed very well. We have nearly 13 schemes. All the 13 schemes were not able to beat the benchmark decisively. It has delivered extraordinary returns from the returns point of view. Let's be talking about small cap. So right from March 2020, March 24, 2024 till yesterday, we have delivered, the scheme has delivered 340% returns. Okay. It is extraordinary number. 340% return is there, where my average beta, if I look at for these 15 months, maybe less than 1, maybe closer to 0.90, 0.92. Okay, today my beta is relatively right now is on higher side, but look at the average beta. So my, if I look at my risk adjusted returns, even it is far superior as compared to just looking at the returns in isolation. So I think it is what is important for us, that how well we play with our risk number. Okay, and as a philosophy, you always say, no, it's all about active, absolute, and unconstrained, which I'm going to talk in a small brief presentation. So our endeavor is to give absolute return. We manage money in a dynamic style, and we look at, we don't want to work in certain constraint. Whatever the regulations are there, that's good enough for us. Okay, so you need that flexibility to to capitalize on the opportunity which is there. So that's the reason I said in the beginning of the presentation, I said my biggest learning in last 3 decades is all about how well you can remove your preconceived notions or biases which we bring to the table.
Yeah. So
I hope I will address that.
Yeah, it's very interesting, a very different philosophy. So that's why I call you a fund manager with a difference. And I personally, they started investing in your funds about a year and a half back, and it's been a fantastic journey. And I've been telling my team, and we have been telling a lot of our clients also. So it's been a very impressive journey. So Sandeep, why don't you generally always give a very good analysis of the market, your fundamentals, your techniques. So why don't you just maybe share your screen and just take everybody through that, and then we can get into a question answer session, because generally we don't do it. This is more of a talk format, but I enjoy your presentation so much that I thought it will be amazing for the viewers to see it, and it's actually when you put PPT plus words is better. It makes it easier and more better to understand.
So I'll just briefly cover that. Let me try. Let me share that. Just you have to give me a minute. Okay. Let me share screen.
Sandeep, somebody is asking the question that what is your book called? I think it's called Being Relevant. No?
Yeah, it is Being Relevant. Sanjiv, is visible? Screen is visible?
Yeah, it's visible.
Okay. So I'll quickly run through the small presentation. So being relevant is our philosophy. Okay. In today's world, as we are growing old, everybody wants to keep themselves relevant, and it's not easy to be relevant, in the most dynamic environment. And this is the front page of our coffee table book, which we have written. And when you come to our office, this is the painting is displayed on the reception area. So it reminds us that you have to keep yourself relevant on daily basis. That is something as a challenge, and it's a philosophical approach. Okay. So when we're talking about dynamic style of money management, okay, and if I have to summarize a very dynamic style of money management, it's all about how to add alpha, adding alpha while subtracting beta. Okay, so we are trying to increase your return and trying to reduce the beta. Okay, this is the motto of money management. Okay, dynamic style of money management. Okay, so let me also run through a small performance which is still yesterday. So we take it from March 2024 low, because that was the lowest point. So it gives you a perspective how we have performed in the current environment. So we're talking about this quant small cap, which is delivered nearly 340% returns. Okay, it has given a outperformance of nearly 141%. Okay, active fund has delivered nearly 200% return, outperformance of 84%. Text plan 288%, outperformance of 124%. Okay, quant mid cap 176, outperformance of 27. Multi asset, okay, so outperformance of 126%, and so goes on. And what is more important, even our sectoral funds like infra fund or the consumption fund, which has given outperformance of 145, 119, or 120%, is one of the best in the category itself. Okay. So, and what is very important, if you see on the right hand side, this is the current beta as of yesterday, because we always try to give you what is my current portfolio beta. But if I look at the last 1 year average, maybe in future we'll try to showcase that, is far lower. Now, obviously, we are closer to 16 16,000 levels, okay, and we have to identify stocks, and overall beta of the portfolio has increased marginally from the previous level. So we have been working for the and all these categories, if you can see the outperformance. So outperformance is not about 2-3%. There's a 50%, 100%, 140%. That's a extraordinary outperformance which is given, and this entire credit goes to a framework which I was explaining, which I'm going to talk about VLRT framework. How this framework has been effective in getting this sort of outperformance. Now let's understand in the market, very very basic things we talk about. So let me start with one specific question. When people talk about that, okay, it's a demand supply. What drive the prices? We say it's the demand supply. Okay, so I ask this question: what drive the demand supply? Okay, is the perception will drive. So let me ask you very basic questions we like to address. At quant, we quantify everything. That's the way word comes. So we are not just quantitative based fund. We quantify everything, including the sentiments. Okay, our focus is predominantly on behavior finance and how well we can quantify. So when we see in the market, people talk about, most of the analysts or broking outfit, or every, even as an institution, we also try to see what could be the future earning of individual companies or the sector as a whole. So people do quantify the earnings, okay, but I have not seen any report till date which talks about what will be the fair value of this company. How would the earnings forecast, okay, is there? Can you give me the valuation forecast? We have not seen. So we're talking about this. Can we quantify or project a fair P multiple, one of the, or any valuation multiple? Okay, this is a very interesting aspect. This we can do through demand supply, which I talked. Demand supply drive prices, perception drives demand supply, and sentiments affects perception. Okay, and this is the crux of a lot of stuff which we do from the behavior perspective, and we combine our statistical, mathematical, or even econometrics model we bring into picture and try to quantify. So it's a data driven, not sentiment driven in any manner, or survey based. We try to get into try to create a mathematical model. So we have built perception analytic and sentiments analytic for nearly 500 stocks in India and most of the asset classes which is liquid and traded in the world. Now, can we quantify sentiments? Okay, we all talk about fear and greed phenomena. Okay, quantification of fear and greed. We have taken one step lead and we actually quantify. Okay, can you quantify risk on risk off? Okay, this is something which we do at Quant. Can we quantify global liquidity? Global liquidity is not all about what we see the FI data or mutual fund data or the data which is disclosed at the end of the day. The global liquidity is far deeper concept. In fact, I will say money supply is the subset of global liquidity. It's a very interesting phenomena which we track very closely. Can we quantify risk appetite? This is an interesting aspect. How you quantify risk appetite. Can you quantify geopolitical volatility? Okay, you can feel it. Something stress is there in this particular region, but quantifying is something very important. And the last one is equally important. We all are living in a world where weather changes or earth analytics related things people are talking about. Nowadays, been a fashion to talk about earth related changes or weather related changes. But can you quantify? Okay, we have tried to quantify these things from the market perspective or economy's perspective. So this is very interesting aspect, how the earth changes and magnetic field also impact the gravitational force, how it has impact on the economy. Okay, as a student of science, we are able to quantify some of these work, so we don't have claim that we have done any PhD work on this matter. What our focus is markets and economies, up to what extent, okay, we can quantify. So very interesting space which we try to do. So anything which affects global markets or global economies, we try to at Quant, we try to quantify these things. Okay, so let me give you perspective in terms of our outlook. So I'm in the book which we have written, I have talked about how 2020 till 2030 will be the wealth destruction phase. So this question has come about, if you believe this is a wealth destruction phase, then we have actually launched our business in this period. Okay, now it's very interesting data. Yes, we believe it's a wealth destruction phase, but it is also an opportunity. And this is the way the genesis of dynamic style of money management is there. If we can optimize this phase, then we can actually enhance our wealth. Okay, but if you if you just keep illiquid asset, which is a lot of people have very large scale of real estate assets, or globally, if I'd say 70 to 80% of the wealth are in the illiquid asset, and that's how, and this illiquid asset will have maximum wealth destruction in this phase, okay, which is linked with some amount of earth analytics also. So 2018 till 2023, we talked about volatility expansion phase. And this is something which is again linked with the dynamic style of money management. So these are genesis of data points which we are talking about as a QGR, which is Quant Global Research. So we have been doing this type of research right from 2007 onwards. 2017 till 2047 is a global reset phase. The way from 1960 till 2070 was the globalization phase. We believe the reversal has set in, and it has far deeper consequences, and that's the reason the trust element on the currency and other aspect will change. And it is with this global reset phenomena, though it's a very complex subject, very difficult to explain in few minutes, but I have tried to just summarize our findings of predictive analytics model. The relevance of US and Fed will decline, okay, and dollar will not be a reserve currency status by 2047, okay. We have been writing about this from 2019, that 2020 will be seen as the top of dollar index, and how the relevance will decline. It has also has a linkage with the how the cryptos or the DLT framework will come into picture, and the relevance of US dollar itself. The way relevance of GBP, the sterling pound, disappeared and gradually diluted post World War II, and dollar took over. Something similar will unfold, though it will be too premature to talk about which currency will take the status. Our view is that it will be the gold-based DLT framework will come into picture. 2020 till 2030, we believe this is the time where developed market will peak out and Asian-centric emerging market will outperform. So we believe that next 10 years belongs to emerging market, and that to Asia-centric emerging market, and India in particular will be a beneficiary of that. It is something very interesting which I'm going to talk about, that when we talked about risk appetite and liquidity. So the way we look at in markets, if I have to link with the energy, we have seen that energy never destroyed, only changes its forms from hydro to nuclear to mechanical. Similarly, when I look at the market as a whole from money flow perspective, it is not fair to say that we lost this much market cap, okay. Actually, market is only the money flow. Actually, money shift from high risk to low risk environment. Globally today, if you look at the developed market, risk appetite is on the higher side as compared to Asia and India in particularly. We believe that money will shift from high risk to low risk environment. This is the way money flow thesis which we have built, which showcase that money shift from high risk to low risk environment, unless a quantitative easing like phenomena comes and more those central bank can pump it. Those are artificial phenomena which will not last for long, okay. It can be there for a few years. So the big picture is about emerging market outperformance and how India will be beneficiary in this period. We believe that 2021 till 2030 will remember as stock for value picks, okay. We believe that all most admired categories of stocks or sectors will remember as a peak in terms of valuation multiple, not necessarily in terms of price or earnings. That's very important to understand when we're talking about the multiple aspect, the valuation, whatever multiple you are giving to, or these companies will not command in future, okay. So we'll talk about value will outperform growth, and fiscal stimulus which is happening is also part of it. India also figures as a emerging market, figures as a value proposition, and within India, value proposition is the theme which we like to drive. And that's the reason our entire portfolio, if you look at any scheme, is more skewed towards value than the growth, okay. We have been talking about right from 2019, we showcased that 2020 onwards, commodities prices will start rally and agri will be the biggest beneficiary. And we have seen in 2020, commodities started rallying, agri has come out. We believe this cycle has potential to last for a decade, okay, and has its own repercussions from a global market. And we believe agri commodities will be winner. And this is one of the reason you will find a lot of agri related, whether it's fertilizer or chemicals or specialty chemicals or commodity stocks in our portfolio. We can't play agri directly, but we can play through up to certain extent through these days. We believe agri is the theme which will give you highest return in next one decade. Another important thing which we talked about, given the earth analytics. So we believe that natural crisis will be in next 10 years will be significantly high as compared to man-made crisis which we have seen. So it's a natural calamity which will affect because of changing earth analytics and changing dynamics will really has a bigger impact on the global economies and in turn will have impact on the global market. So this is the broader view which we are trying to present. Okay, so we talked about predictive analytics through in we also run a small newsletter sort of thing on which is quarterly basis comes out. We started in February, next one is due sometime this month. Okay, so we talked about predictive analytics. In this we're trying to quantify fear and greed. Okay, it's very important. You can feel that people are bullish or bearish. Okay, quantifying is something is very interesting and we try to do it at Quant. Okay, so we briefly talked about our core belief, the fundamental Atma, liquidity, and the sentiments, the Maya. These are three things which we have already addressed, okay, in our previous discussion. But this is a really core belief for us, okay. We try to incorporate whatever work we do really help us in giving a three-dimensional perspective on the markets. In terms of investment philosophy, if I have to talk about, we briefly talked about our focus is dynamic style, which is very active way of money management. It is our endeavor to give absolute returns. That's the part of philosophy. And I explain unconstrained. We don't put unnecessary conditions on market. We are completely agnostic. We are style agnostic, indices agnostic, except we follow the regulation part. If it is a part of then those stocks will be part of our mid cap or small cap, or depending on which category we quantify, which is part of these stock selection, but broadly completely agnostic. Okay, and that gives us huge amount of flexibility in them. Now, in terms of looking to the next slide, okay, these are the investment principles. So, as we said, the word quant comes from the background. Okay, you have seen all mathematical simple, it's quantify. So, measurable is reliable. That is a very important investment principle for us. We talked about quantamental, okay, which is a combination of your judgmental as well as the machine. So this is the way machine plays a role with us. Okay, that's a phenomena which is picking up globally. Okay, and we talked about multi-asset, multi-manager as a concept. We definitely look at multi-assets, and multi-manager is very important to understand. It really helps us in diversifying the risk from the market, as we believe that every scheme is managed in the three style: liquidity analytics, valuation analytics, as well as risk appetite. Okay, so it's a part of our principle. We talked about money flow aspect. So we actually track money flow from how money flow from one asset class to other. And the last one is about a bold view on timing is everything. We are very vocal about it. We put in a lot of efforts. So our predictive analytics models is based on that. Ultimately, what is the objective? Objective is to identify a risk on risk of environment. We were able to quantify event much before it unfolds, because it is based on the market implied data which we try to build. All the thesis is based on that, and hence as an investment principle, timing is a very vital tool for us. Okay, and this is where I request people to understand the treatment is different. It's not about trading. It's all about how well you quantify your data analytics. Okay, as a combination, you can have a better handle on the markets. Okay, so it's a much deeper concept than a lot of people believe. About trading is timing is all about trading. It's a far deeper concept for us. Okay, and it's a part of our core investment principle. Okay, so we talked about dynamic money management through VRT framework. We talked about multi-dimensional approach. Instead of just looking at the valuation analytic, which is unidirectional, we look at the multi-dimensional, and that what leads to the VRT framework. Okay, and this can be best explained, or four elements in motion. If you look at this, is the clock is there, which showcase a timing aspect. Rupee symbol is there. It's like your portfolio, how well you can balance it. This is what I was trying to explain, Sanjiv, earlier. When people say, in today's market, valuation looks very rich. Okay, whether it's a time to get out of the market. In the month of March, valuation was nothing changed on the valuation, but what changed was the risk appetite and liquidity phenomena. Okay, and when risk appetite started settling down, what was rising? It was only liquidity was rising. So it's very important how we balance all these four elements. Sometimes you are seeing valuation getting skewed, or risk appetite getting skewed, or the liquidity getting skewed. How well you balance your portfolio. That is something where VRT framework really gives us balancing approach, okay, and it really helps us in optimizing my risk adjusted return in the market. And this is something which we are very proud it's working very well for us. And you also have to understand this is a continuous process. It's not like we have built something. When we ourselves talk about, we live in a dynamic world is changing, new elements, new data points. We keep on backtesting, and we backtest everything in US market, which has a 120 years of history. It's not fair to say. A lot of people come and present to us also. In India, we have backtested. Okay, what is the history of India? Hardly 20 years. We don't find even clean data. Okay, so entire thesis or whatever thought process we bring to the table is based on the developed market. So we look at UK market or Germany market or Japan market or even US market for history of backtesting, because that gives me, because ultimately we are dealing with human beings. Okay, the intensity of fear and greed can differ. Emerging market, the intensity is on a higher side. In the mature market, is on the lower side, and it varies from countries to country or regions to region. But ultimately, fear and greed is a phenomena which drives the market, and we are dealing with human beings. Okay, so it works very well across all asset class across the globe. Okay, we talked about how we keep on asking this question whether it's a art or science. I think the investment is all about combination of math, science, and arts. It's all about applied math and behavior finance. What is the pragmatic approach you bring to the table? This is what we said in the beginning. We learn from mistakes, so we put processes in place, okay, systems in place, so that we don't repeat the same mistake which we have made in previous thing. It's not possible unless you put your process. So at Quant is a very process driven organization. Okay, there will be phases, okay, where we will underperform. If we believe that this is the risk of environment has started and market is in a euphoric phase, we will change our strategy and we will happy to live with underperformance, okay, rather than taking unwarranted risk. So we are relatively risk averse organization in terms of approach, and predictive analytics model really gives us edge, okay, in terms of identifying the early phases of risk on and risk off. So it's a combination which works well. Okay, lot of proprietary knowledge we have built over a period of time. Okay, these are data driven organization. That's the reason we call ourselves we are slave of data. Okay, whatever data is endorsing, we are willing to change our view. We are not married with any thesis or philosophy or any this. What we are married to analytics, and if something is changing, we don't work on assumption. This is the next few year forecast based on certain assumption, and that's the beginning of the presentation we talked about. It's all about implied data, what market implied data we factor into rather than the assumption based data. That's a big differentiation point in terms of predictive analytics. Okay, we try to look beyond obvious. Okay, this is a larger perspective because we believe that reading between the lines, what we taught, is very important, and the best can be practiced. We have to really look beyond the obvious in the market, and we practice on daily basis. We try to, when we see a news flow result, sometime one company give extraordinary result and prices moves up, and sometimes when company gives extraordinary result and prices comes down sharply. So we need to quantify up to what extent a particular event or news or numbers is factored, and that is not possible if we don't quantify on multidimensional approach. We try to get through sentiments data, we try to capture. So it's not easy, but we still try to practice it, and we try to keep on evolving. It's an evolving thing over a period of time. Okay, so we talked about another important concept is about leverage economy. Okay, it's very important to understand because the fear and greed is actually reflected best in the leverage economy market. Okay, and that's the reason a lot of people look at the derivative data very closely. If real economy is X, the leverage economy is 10 to 12 times of that number. So in fact, we are trying to showcase that this is the leverage economy drives the real economy, not other way. Okay, and this another important aspect really help us in quantifying the fear and greed for global asset companies. Okay? We talked about volatility. Okay, this is the another asset class we defined it. We call it the invisible hand. And if you can understand and identify this invisible hand, it really helps in terms of rebalancing your risk in your portfolio, because volatility gives you much early lead in these data points. So this is a trinity which we talked about. What best gives you the fear and greed combination? There's volatility and credit and leverage. These three phenomena or concept really helps in quantifying the fear and greed. I'm not getting into details of that because it is a time, and I can talk for hours, a time consuming process, and it takes time to explain. Okay. All these points we have largely covered, how perception analytics we look at. Okay. And last thing we talked about how earth analytics. So we believe that we already have entered into a cold wet environment. This is one of the reason why we are saying that the next 10 years we will see extraordinary cold and wet environment. This is a lot of data which we have pulled from the NASA website, or a lot of scientific data is there, how the weather condition will deteriorate in next 10 years. Okay. And these are the how the sunspot cycle, or the how the magnetic fields are changing. Like I generally give this example how the magnetic fields affect us. We have all taught, the North Pole is in Canada, but if you sit down and analyze and search now, it is in Siberia. Okay. And in last 10 years or last 20 years, the pace North Pole has shifted. Okay, it is a phenomenon. It has its own repercussions on global market. It has its own repercussions on various economy, and we don't claim that we are masters of these science. Okay, but over a period of time, we understood what really help us. So when we were in 2012, when we were working on these data points, and our predictive analytics model was endorsing that 2020 onwards, the biggest bull run of agri commodity will start. That's the time we started trying to understand if agri bull run has to come, it has to be led by weather changes. Only weather deterioration can lead to this sort of prices. So we have put in last 8-9 years in understanding a little bit about Earth analytics, and we are able to work a lot on 150 countries in last many years, how these temperature cycles or the magnetic field or the gravitational force has really changed these markets, and something which we have tried to showcase in our book. Okay, with the caveat that we are not master of these things, but we understand what is coming, and it's important to keep these data points as the additional inputs in our models. Okay, so this is all about. So we talked about. So in 2019, nobody used to talk about inflation. People used to talk about low inflation and low interest rate. So the thesis, which is low for long. Okay, that was the thesis. The whole world has built on low for long concept. Okay, and in 2019, we have talked about return of king. There's inflation. We said that, and we have talked about from the 2020 onwards, commodity prices will start rise, and second half of 2021, the inflation will come back, and it can remain at elevated level till 2027, till 2028 on global market, particularly in the developed market. Okay, so it gives you a sense. In May 2019, we talked about inflation coming back in second half of 2021. This is something, if you look at it, will gather momentum. You read this slide, in 2020, global market experienced a mild growth inflation numbers, and will gather momentum from 2020-21 as Earth analytics, okay, accelerate. As per similar historical episode, our macro models and cycle analytics believe that inflation will remain elevated till 2027-28. Okay, so this is the broad thing.
Thank you, Sandeep. Very insightful and a very unique model. How we are relating temperature to investing, and I think, but future is going to be quantitative and analysis of data, because we are living in a world where there is humongous amount of data, and the people who are going to be able to mine this data are the people who are going to lead. And it's almost seems like a science fiction movie, that where data is going to be the king and data is going to predict everything. So let's hope this happens, and let's hope that you're able to play important role in that. So just taking some of the questions. So guys, let me ask you a question, that if you were to invest in for the next 1 year, what type of fund would you choose? Would you choose a flexi cap, small cap, mid cap, large cap? But so I would like all the viewers who are watching this show to put in their views for us to understand that where do you stand, and then we'll ask Sandeep to take this question. So, and in the meanwhile, Sandeep, we have had people who have been asking us some questions. I know we are short on time, so I will bounce some questions to you. Some questions I'll try to answer this thing. There are a lot of people who need a job. So, both the organizations are growing and we are very happy to recruit people. You can always reach out. See, what we want is people who are going to be loyal, and they need to have a basic amount of knowledge and information and ability to work hard. So if you promise me that you will give us your next 10 years and work honestly and diligently, I can promise you I can give you a job and I can give you a great career, at least from my side. And I'm sure Sandeep would also be in the, in the
Yeah.
same boat. Okay? And then there's a question by Kanesh Gupta. He says, what do you think about very frequent switching, and does it affect the mentalities and hold us back from actually judging? So, Sandeep, this is a very important question, that when we buy a mutual fund, should we just buy it and forget it, or should we keep looking at it at a regular interval? I have a very firm view here. What is your view?
So I tell you, as I said in the beginning, mutual fund through equity or equity participation through mutual fund, because equity asset class is definitely a long term. Okay. Now, when we try to work in our own schemes, our horizon is both longer term perspective that equities will outperform other asset class, but within equities, how well we can switch from within sector, within stock. That is our capability and our ability to work on our models. Maybe for a normal investor is very difficult to do that, and hence we also don't advise that you keep on switching. Mutual funds are not like your stocks that you can flip and move on, and then you lose the tax benefit also. Okay, that's the reason, at least whomever we are interacting, we are always saying participate through a longer term perspective, because the asset class itself has a long term perspective, and every data point showcase a long term you will be beneficiary. We run it for you. Okay, if I have to look from a short term, near term correction or volatility in the market, I will readjust my portfolio. Okay, so as an investor, you don't have to worry about that. It is the responsibility of a money manager or particular scheme manager or fund manager what he's doing. We call it money manager because we don't actually manage funds. Okay, so it's a wrong terminology. We manage money, so we call ourselves a money manager. Okay, so as a money manager, it is very important. It is our capability, since we are looking at these data points. We have put a lot of processes in place. So I don't think investor, neither they have that capability, nor they should spend in time in building this capability, because this is a very specialized job, and it requires a lot of patience and investment which we have built or done over a period of time. So mutual fund as an asset class is a long-term asset class. You don't have to switch from one scheme to other on continuous basis.
So here, my view, guys, is that you have to, I won't say you have to switch, but you have to definitely look at your portfolio on a regular basis. See, as they say, one of the very easiest ways of switching is to do asset allocation. Okay, that's what I normally tell my team, that allocate the asset. This much money is going to be in flexi caps, this much in large caps, mid caps, small caps. And what happens that when one of them is underperforming, you end up putting more money from the outperforming sector into the underperforming sector, so that when the market turns around, you're there in the underperforming sector. So, so point is that it is important for for you to do an asset allocation, and this asset allocation is an automatic switching. So that's one of the easier ways to do it. Second is, taking a call on the people who you feel are going to outperform the market. So it's about learning about fund managers, what is their style, the mutual funds, what are they likely to do. I meet so many people who have been investing in equities and they have chosen schemes which have not performed at all, and that underperformance has lasted 5, 6, 7 years, and they have missed this humongous bull run totally because they just stuck at one place. So, guys, you have to look at and you have to take some call on who is the right person, which is the right fund. So, you need to have a good wealth manager with you. A wealth manager may, you may end up paying 0.5% or 0.75% extra, but a good wealth manager should add at least 3 to 5% or 6% to your returns. On a good thing, worst case scenario, even if he adds 1% return, it will make a difference. So, guys, do look at your portfolio at least once a year. Yes, don't do it every quarter, every month, but do look at it once a year, and do take some calls that who are the people who are going to be, and don't depend on past data. If somebody has done well in the past, doesn't mean he'll do well in the future. So you have to decide on who's likely to do well in the future and why. Like Sandeep has said, he firmly believes agri businesses are going to outperform. So I'm sure the portfolio is going to reflect that. He's taking a call on the future. He's not taking a call on the past that look, pharma has done very well in last 2 years, so I put all my money in the pharma. So guys, please follow the future, don't follow the past. So this is one question.
Sanjeev, I just want to add what you have said is rightly. In fact, this is a very common mistake. People, your non-performers, not only stocks or the funds, it becomes your core holding. Wherever you are incurring losses, it's a human tendency, and this is what we have said in the beginning. We have learned from our mistakes. That's the reason we review our portfolio in a dynamic manner. Okay, and we keep on assessing. I completely agree from this perspective that you have to evaluate. Okay, and one thing, at least this COVID has given us, a lot of people got an opportunity to sit down and analyze their portfolio, which they were never got an opportunity to do it earlier. So I think it's a good thing which has happened.
Yeah, and so when we are talking about people, most of the people are talking about mid cap, FMCG, flexi cap. Flexi cap seems to be very popular. So Sandeep, again, very less trading. So how would you, what kind of funds, like even in your own portfolio? For me, I love what you have done. But one of the causes of concern for me is the number of schemes because it confuses me. So point is that if the investors are asking this question that Sandeep, give us 2 3 schemes. We can't afford to invest in 12 13 schemes. So what are the 2 3 schemes that people should look
So,
at and say,
Sanjeev, the way I look at it is also linked with the risk profiling of an individual. As I said in the beginning of the presentation, that next 2 3 years, okay, 1 year is past, at least for next 2 years, good amount of confidence we can say the mid and small has a potential to outperform. Okay, if somebody has a relatively higher risk appetite, okay, and in if age is on his side and he has made good amount of money, I think good amount of allocation should be given a small and mid cap space. From the current level, I think mid cap portfolio looks far superior from the near term perspective, because valuations are definitely rich, but it has good amount of liquidity. Okay, and but if somebody is let's say somebody is trying to get associated with us, we always recommend to be part of our active fund, which is a multi cap fund. It gives you perspective of all the things, and depending on my view or the or the money manager's view, we tend to rebalance our portfolio depending on the timeline and the data points which is saying. Okay, so like I'll give you some small example. Till August or till November or something, we were running like 83% small and mid. When risk off environment came in the February, we have increased our large cap, and now we have again pruned down our large cap, and we have again increased our mid cap exposure and small cap exposure. So that gives you a flexibility. If somebody is new, the best strategy is to participate to multi-asset, multi-cap funds.
yeah. So guys, I 100% agree with Sandeep, and it is very important that unless you have a huge portfolio, it is better to go for flexi caps. Where the fund manager is taking a call between small cap, mid cap, large caps. He's moving your money around, and he's doing that hard work for you. Okay. Otherwise, as Sandeep has said, look, you must have some allocation to small and mid caps, which are high risk, and they have performed really, really well. At least the small caps have, performed very well in the last 1 year. So that also puts a question mark whether they'll continue, because there needs to be a correction in some of the places, or this is the correction. Nobody can predict that. So, so flexi caps are very, very good. Another question we are getting, Sandeep, is that should there be international allocation, and what is your view on the feeder funds, and would your funds in future be having investing in international stocks also?
So, from a diversification point of view, also, yes, one should have a global exposure. And we are also in the process of appointing a global custodian for that, because relatively we are, though we took over one of the oldest mutual fund company in the country, but we are still putting process in place. So we have just appointed a global custodian. We will be doing it. But I also want to give you one caveat. Okay, a lot of people or the investors have seen a euphoric move in the US market, and we get a lot of questions related to market in US particularly. A lot of funds are getting launched globally. Okay, I just want to give you one signs of caution sort of thing. We believe that US market, particularly the complacency indicator, the quant complacency indicator for US equity is on the lifetime high, which means the vulnerability of US equity is far, far higher. Okay. So if anybody is looking for US investment, we are not looking at US investment on immediate basis, even we get the approval, because we believe the vulnerability is relatively high. If we get opportunity, we look for other markets, whether you're talking about Asia market or Vietnam's of the world or Philippines of the world or maybe Japan's of the world, depending on the opportunity, just as a cautious approach, because that's what our predictive analytics models are endorsing. Okay, even we launch it, we are relatively more cautious on the US market at this stage.
Yeah. So I think very well answered by Sandeep that, from a risk diversification perspective, you need to have some international feeder funds. My own personal view is that you need to have at least 15 to 20% of your money into international market for the sake of diversification. And this is a strategy which has worked amazingly well over the last 5 years. Whether it will continue to work well or not, nobody can predict. But today we are living in a global economy. So we are living in companies like Apple, which are operating all over the globe, or we are living in a world with companies like Alibaba, or we are living in a world with the companies like Facebook, Google, as I've said, which are global companies. And why should you not be a part of it? If they're going to be coming and growing and doing business in your country, why should you not be participating in that journey? Feeder funds are a very convenient way of doing it, but otherwise, it's very, very important. And also, I would like, as I've said, it's very important to have a very good wealth management firm behind you for this journey, which is doing a lot of research, which is understanding the funds, and which can guide you at the right time at right places. Because a lot of markets may, if you remain invested, you will make money, but you have to remain invested in the right funds, and you have to be there. Somebody has to be there to guide you at the tough time or the right times. Okay, so I have seen so many people stop their SIP when the market crashed last year, and look at the kind of losses they have made, or so many people withdrew their money, and a lot of the Sandeep would know these figures more, but there was much more redemption in direct funds than advised funds, because of the fact that people panicked and they were just taking a short term. Like right now, stocks have been giving returns, so everybody is into direct trading. Now, whether that will continue to last or not is very difficult. But yes, if you have a good fund manager who does it for bread and butter, he's going to be going to be great for you. So, Sandeep, a lot of people are asking. Maybe we can take this as a final question. That what are the types of stocks can we see in quant active fund or your other popular funds? What is the themes? How are you going about investing? What is the time horizon that you are looking at for the stock picks that you do? We've understood the whole framework, but they are asking more, like if you want to talk about IT, pharma, or any other sectors, and how you are going about this thing.
Okay. So, as I explained in the beginning also, that we try to balance our portfolio from a longer term, short term, and even instead of having cash, we like to keep a special situation like a trade. So from a medium term perspective, we believe that chemicals, specialty chemicals, agri, or healthcare, that is a theme which will continue. Okay. So we are very bullish on healthcare as a theme, and post pandemic, okay, the healthcare is on the forefront. And the way we started this in like 2019 onwards, we are building our exposure towards insurance. I believe now uh, hospital space or diagnostic companies, these are the space you can't live. If healthcare has to grow, then hospital industry also has to grow. That's the reason you've seen our portfolio is relatively more skewed towards healthcare in a big way, followed by pharma, followed by specialty chemicals, agrochemical. I think that's a very good amount of exposure, though we were very bullish till recently on the technology stocks, but we have pruned down our technology exposure, except few names. Okay, because as I explained that we believe vulnerability in US is very high. Our data analytics is showing that that the price multiple of these sector will gradually decline. We have seen the peak of that cycle. We are at the fag end of that peak. Okay, it is very very difficult to quantify and time in days wise, month wise. Okay, we are getting early signs. We believe IT has seen the best. We like financials from current level, healthcare from the like we were significantly underweight on financial for long period of time. In last 2 months or last 3 months, we have actually pruned down IT, have increased our financial exposure because we believe. And another thing which we like from a longer term perspective is about the beaten down, neglected. So a lot of PSU as a themes which is qualify for value. Okay, not all PSUs in general, but select PSU we like from a longer term perspective. He has a they are typically have a monopoly in certain sectors, and their valuations are very, they're beaten down names. They're like, if I have to call it, they quantify in the most hated territories, neglected territories. So those are the names which we like to. We have started buying. You've seen we have PSU exposure between 12 to 20% of our exposure, depending on the market opportunity. That's a space which I think will give us opportunity.
So thank you, Sandeep, for an amazing talk. And you saw one of the comments for Mr. Jain. He's saying one of the best episodes of FINtastic Talks. So thank you for being here, and thank you everyone for coming and joining. We hope that we were able to add value to your life. Please continue investing, be a part of India's growth story, just and make India's best entrepreneurs work for you. So thank you for being here. Thank you for joining us, everybody, and thank you, Sandeep, for coming.
Thanks, Abdul, and thanks everybody to really give us the opportunity to hear our philosophy. Thanks a lot.
Yeah, thank you.